Executive of the CME Group in Chicago, Larry Shover from Official Capital Management is standing by. Let's just talk volatility, because even looking at this session, Larry, it's been quite a swing session. Inside of all of that, what are the volumes like?
Well, the volumes actually are pretty light on the downside. What we're seeing in the equity markets in particular, that even though we have dropped below that very important 1220 pivot number, it's been met with strong volume. So it doesn't seem like we're going to drop a whole lot. But the important thing to recognize is the implied volatility of the S&P 500. The VIX right now, it is up a little bit, but it's not up that much. But let's talk about the big picture. If you look at where the S&P 500 was trading back in May, where it is trading right now, the VIX actually was trading below 16, and now it's trading 18.5. Why the difference? And I do believe the difference is in what I call like a cross-asset volatility stickiness, if you will, where other markets like the FX market, the sovereign debt market, the interest rate market has such a big influence on the equity volatility right now. So what that's going to say is that the VIX index, which measures fear in the market, might be inflated a little higher than it needs to be.
Could it be also, though, that markets are now in a bit of a holding pattern? We know from your perspective, from your economy, next week is the big data dump release time. So for now, you wouldn't be expecting any big positions to be taken at all, and that's just keeping volatility in check.
That's correct. And also keep in mind the run-up we've had in the foreign currencies against the dollar. The dollars make a big reversal today, even against the Australian dollar. I can't believe it, but the Aussie is actually lower today. That hasn't happened in a long time. The same thing with the credit markets. The credit markets are actually a little firm. Equity markets have fallen off a little bit, but look at where we've come from. Right now, it seems like the news out there right now is very small. We did have a little bit of a wholesale number that came out this morning that was a little bit weak, and it seems like the equity market couldn't recover from that. But by and large, this seems like a lot of technical reversal.
What are they really looking for? What is going to be the next cue to jump to get into these markets? Because you know, the criticisms have always been, for as many months as I can remember, that you're not going to get those people on the sidelines back in until there is not just sort of a one-hit wonder rally, but it's a big, sizable burst that has got momentum behind it. What's going to trigger that?
Oh, boy. Well, what's going to trigger that is if this quantitative easing doesn't do what it's expected to do, or if we have hyperinflation. Now, as you know, in the U.S., we do have inflation, and it's probably a little bit bigger than most people would admit. But if we have inflated hyperinflation, where the U.S. dollar is just continually driven down, that's going to be bad news for the U.S. But right now, with things going fairly well, quantitative easing is working, inflation is perking its head up, and it's doing what it's exactly supposed to do. Right now, the play in America, the best inflation hedge would be to buy large cap stocks. I think that's the best way to guard yourself against inflation.
All right, but where's the growth for those large cap stocks going to be coming from?
The tax cuts?
Well, I mean, we've yet to see those announced. Obama has, been cajoled into bringing them about. But I mean, is that a given?
No, I think if you're talking about tax cuts in the U.S., the extension of tax cuts, they have to extend all of them. And they need to cut discretionary spending, because the people in the upper categories are the ones that are going to create the jobs in America. At the end of the day, we need our employment figure to go much lower than 9.6% for this economy to recover.
Larry, how long does it take between a kind of decimation of the Democrats in the House and a policy like that being signed off by Biden, by Biden at least, by Barack? You know, what is the time horizon? We're not talking China in 2 minutes to a solution. Is this a 6-month game plan?
It's going to have to be a 6-month, because, as you probably know, we have a lame duck session starting in Congress November the 15th. So between now and the end of the year, I think the Republicans in power are going to do whatever they can to extend the tax cuts. But beyond that, they can't get a whole lot done because it's a lame duck session. It's going to be 6 months, easily.
All right, Larry, go.
But don't they have to do this by January 1? Because isn't that where the original expiration date for many of these cuts?
Yes, and we're all hoping, and I think the market's implying that these tax cuts will be extended to everybody, or at least there'll be a strong compromise to help the market. I mean, the market, I think, is pricing this in. If something should happen to the contrary, where these tax cuts aren't extended to everybody, I think we'll see 1150 in the S&P in a heartbeat.
Larry Shover from Efficient Capital Management, thanks so much for joining us.